There are a lot of unexpected things that can go wrong with investing your money in the stock market. But in this video, we're going to talk about 10 mistakes that beginner investors make that I have personally made myself so that you can hopefully avoid those and give yourself the best chance to succeed when investing your money in the stock market. By the end of this video, you'll have 10 easy things that you can avoid, and also so that you can hone your strategy to give yourself the best chance for success when you're investing your money in the stock market. My goal is that after watching this, you'll be giving yourself the best chance to make money, avoid losses, and find enjoyment with actually investing your money in a stress-free way. Mistake number one is setting unreasonable goals. A lot of time you hear people saying and asking questions like, how do I double my money in 1 month? How can I get a 50x return? How can I beat the stock market? And a lot of times these goals are extremely unreasonable, and the methods to actually get there are extremely risky. If you want to double your money in 1 month or 5 minutes even, go to Vegas, put it on the roulette table, spin for one color and see what you get. But some of these goals that beginner investors set, or investors no matter what stage they're at, are very unreasonable and really hard to achieve. And the only way to achieve those in many situations, unless you're doing a lot of research and a lot of work, is to only be investing in really, really risky assets and really risky stocks and companies. So for most people, the first mistake that you need to avoid is setting unreasonable goals. And the way you can do this is really think about a long-term strategy for your investing and think about things that can actually allow you to make money rather than finding ways that can put you at unnecessary risk. Number two is investing in things that you just don't understand. It's really easy to get caught up in all the noise and all the investment gurus that are out there telling you what to do, and my goal is not to be one of them, just give you unbiased, helpful advice. But getting caught up in that noise can make you invest in things that you don't understand. And when you don't understand your investments, it can really make it hard for you to determine when you should buy, when you should sell, and what your long-term strategy should be with those investments. So mistake number two to avoid is investing in things that you really just don't have any idea about. Usually the things that actually you don't know about are the things that can cause you the most stress and sometimes cause you the most losses as well with investing. Mistake number three is having a short-term mindset. A lot of the people that are watching this video, watching my channel, and just getting started with investing have a long time to be making money on their investments. So having a short-term mindset can be something that can really hold you back with long-term financial gains. A short-term mindset also brings you back to that first mistake, which is having unreasonable goals. So if you have a longer-term mindset about how you want your money to grow through the next 10, 20, 30 years till retirement, it's extremely helpful for you to actually remain more reasonable with your goals and get better returns on your investments as well. So having a more long-term mindset, avoiding that short-term, get returns in 1 month, get returns in 1 year, whatever that might be, can be really helpful with establishing a more consistent growth strategy with your investments. Mistake number four, and this is a huge one and something that can cause a lot of stress and a lot of pain to a lot of people, is investing money that you cannot afford to lose. It is extremely important that when you're investing your money, you're not thinking of it just as a game or just as a sure way to make money. With the stock market at all-time highs right now, sometimes it's easy to get caught up in the hype and think that you can just make money no matter what, and you can invest all your savings in Bitcoin or whatever it might be. But using money that you cannot afford to lose can be extremely risky, put you in a ton of stress, and also cause you to go into debt or potentially even bankruptcy depending on how much you're actually investing. Mistake number five is related to your emotions, and it is selling when things get bad. A lot of beginner investors, or just a lot of investors no matter what, sell once the stock market goes down, once their stock drops, once they hear one bad piece of news. Selling when things get bad can be really harmful for your portfolio in the long run. Just remember that just because there's one piece of bad news, it does not necessarily mean that the whole entire company or the economy is never going to recover. Sometimes when things get bad and you actually sell, you're selling at what's actually the opportune time for you to be buying. So you're doing the opposite of what you should be doing, and a lot of that is tied to emotions. You seeing something go down, you're watching your portfolio, and you decide, I can't lose any more money, and you have to sell. But a lot of times when you sell is actually close to the bottom, and then when the stock is actually going to go up. It's different for all investments, and that might not fully stay true depending on what stocks you're invested in. But again, this is just a mistake to avoid, and selling when things get bad. Make sure you do your full research and understand why things are bad, and see if you think it might recover again in the long run. Mistake number 6 is the opposite of number 5, and that is only buying when the market is good. And this can mean that you're actually buying at the most expensive time in the stock market when it actually might be closer to a peak compared to closer to a bottom. So it is really important to remember that just because there's a lot of hype around a stock or around the market at one specific time, that might actually not be the best time to buy. All of this is going to depend on your personal investment strategy, but it's really important to try and avoid getting caught up in all that hype, because many times that can cause you to buy at a top, and it's actually then going to reduce your future potential gains because you bought it when it's really high, and the upside from there would be less than if you bought it at a time when it was more fairly valued. We see a ton of people online right now talking about buy Bitcoin, buy the stock market's only going to go up from here because the Fed is pumping in money and all of this stuff. And although that might be true, and in the long run it still could be very beneficial for you, just because people are telling you to buy or just because things look good does not mean that they will stay that way for a long period of time. So that is number 6 to avoid. Number 7 is the one that I personally have fallen into so many times, probably the most out of all 10 of these that we're going to go through. And this is selling too early. So it's a little bit different than the last two, because selling too early is when you don't actually have a long-term view for your stock, and it also relates to not knowing enough about your stock or being caught up in the hype. I have personally lost potential gains of tens of thousands or hundreds of thousands of dollars because I got caught up in emotions and I actually just sold too early. I've tried to figure out how to time the market, and a lot of times it just left a lot of money on the table, and it left me having to make more decisions about where to invest my money. A lot of the stocks that I sold too early, if I still held on to them today, my gains would be far higher, a lot of times 2 or 3x higher than when I sold them a few years ago as well. And although I still did make gains from these stocks, it's important to remember that timing the market is not something that most people will ever be able to do, and some people would even say is impossible. So please try and avoid the mistake of selling too early. A lot of times having a more long-term view on a stock or on the stock market can reap longer-term benefits, dividends, and other growth that actually will compound in your portfolio year over year over year. And right before we get into number 8, I know everyone hates this part, but it really helps me. If you are enjoying this video and you would be so kind to just give the video a like, write down in the comments what you think, or even subscribe to the channel. It seriously helps me out so much. I really appreciate it. And I know these plugs are annoying, so let's hop right back into the video. So number 8 is getting too involved in your portfolio and in investing. So many people get way too involved in all of the strategies of their investments. Online trading apps like Robinhood have made it so easy for you to check the performance of your portfolio on a minute-by-minute basis. But many times, getting too involved in checking your portfolio all those times can cause you to get too emotional and cause you to make way more decisions in your investments than you actually need to. Sometimes it's the best decision to just buy the stock that you feel comfortable with, that you've done some research on and you feel like has long-term potential, and then you don't even look at your portfolio for a few months. It can be extremely beneficial not only to your stress levels, but also to your future returns on your stocks and your investments as well. Getting too involved in your portfolio can just cause a lot more mistakes than if you were to just buy things and let them sit for a longer period of time. If you're truly confident in your investments in the stock market, you should be able to just let them sit in your portfolio without looking at them for a few months and know that they're gonna be okay. Number 9 is listening to too many people. And it's crazy because here I am telling you mistakes to avoid. I'm one of these people. But there's so many people online that will do ads like this.
I'm sitting here in my really nice car and I'm going to tell you how I made billions of dollars in the stock market. If you just subscribe to my email list every day, I'm going to send you 3 stocks that I'm buying and I'm selling. All the technical analysis is already done for you. You need to subscribe to my email list and we will make money.
And those ads can not only cause more confusion, but they can create way more mistakes and way more decisions that you have to be making than most beginners actually want to be making. So my recommendation is to find a couple people that you can really trust, get involved with them, listen to them specifically, figure out if your philosophies match, and just use them as your guide for how to make some investments and how to grow your portfolio over time. Getting caught up in all of the people on Reddit, on YouTube, on CNBC, there's so many ideas out there. Everyone thinks they're the smartest person. Everyone thinks that they can tell you what to do to make money. But just remember, too many people can cause way more stress and way more harm than good. And number 10, we've made it to the last one. This is something that has come up so much in the news. I made a video on it as well. But getting too complicated with your investment portfolio and your investment decisions is number 10, and something that not only can cost you a lot of money, but can even wipe out all the money you have in investments. And this is because some people that really just don't have the time to be investing this much money in complex strategies like put options, call options, short selling, margin trading, cryptocurrency, whatever you can think about it. There's too many people that are getting involved in technical analysis and these really complex investment strategies, when in reality, all they should really be doing is purchasing index funds or ETFs or funds that allow them to grow their money for a long period of time and compound it year over year over year. Getting involved in these really complex strategies, again, can cause more stress, can cause you to get more emotionally involved, and can be an issue for the growth of your portfolio and allow you to underperform compared to some of the more simple strategies. Although those simple strategies might not be the most glamorous, or they might not be something that you can show off, some of those long-term value investing strategies that are not complex work for the large majority of people way more than the time that you would have to spend investing in learning how to do things like options trading, short selling, trading on margin, cryptocurrencies, and all those other assets that might be out there for you to invest in. And if you have any other mistakes that I missed, put them down in the comments and I will respond almost immediately. Thank you again. I'll see you next time.